Hey guys, this is Scott Horne with the Owner Finance Network, and we're going to have some fun in this video. I'm just going to talk about looking at your strategies to maximize your profits in some creative finance deals that we do out there. This is one of the things I really like to talk about. So if you like the video, don't forget to take a minute and like it. Make any comments below. We'll do our best to address those for you. And don't forget to subscribe to our YouTube channel as well. So guys, every deal we do as an investor is different. I don't care what it is, whether it's a cash purchase, whether it's a creative finance purchase, and every deal we come across is unique. It's not just the property itself, the condition the property is in. It's the loan on the property, if there is one, other liens on the property that might be out there. It's the seller's situation, how far behind are they in payments if they are. All these things roll into the equation. It's the demographic makeup of the neighborhood where the property is located. And what I mean by that is that, you know, there are some neighborhoods where 100% of the residents of that neighborhood can qualify for an A+ mortgage. Then there are other neighborhoods where you know good and well maybe 10% of the population of that neighborhood could actually qualify for a mortgage. And every situation is different, and it causes you to look at and to analyze each house and each situation differently. For instance, you know, there are houses we can buy where we get lucky to come in to buy a home, let's say, subject to the existing debt, as we know what that means, that maybe there is sufficient equity in it that allows us to do a fix and flip. For instance, we worked on a transaction over on the west side of Fort Worth a few years back, and our seller was nearly $100,000 behind in payments. On top of that, the house needed another $30,000 to $40,000 in renovation to get to market. They had no options. It was too big of a rehab, too big of arrears, and they were going down the hill to foreclosure rapidly. But substantial equity in the deal once we could get the house improved. The problem is the investor marketplace for that deal, you needed well over $100,000 in cash to do the deal. You're not going to get a second lien from a bank for that. Private lenders aren't going to put up $100,000 or more to do that deal. And very few investors have that kind of capital to make it happen. So therefore, they were stuck. But that was a situation in the neighborhood where it was, that because of the high influx of capital being put in, it would take a long time to recoup those dollars, even if we borrowed it from a private investor. So it lent itself more to a retail scenario. And in this situation, because of the equity in the home and the ARV of this house, and the neighborhood that was a quality, low day on the market, good retail neighborhood, we were able to go in, secure it, close it because we had the capital to do it, get the home renovated, and we sold it full retail value and made a very attractive profit on the deal. So you can come across deals like that, but you need to know how to analyze it up front, both when you're talking to the seller as well as what is my back-end strategy going to be. And guys, let me make this comment too. When we go into a transaction, I don't go in just to secure the deal day one. I already know my back-end strategy before I even negotiate that first deal. I got to know what I'm going to do with it and my plan, because it really affects how I do that deal. On the other hand, for instance, we bought a home on the east side of Dallas recently, where it was in a newer subdivision. They're building new houses. The loan balance alone was equal to the current marketplace of houses. Forget the money that was needed to do some minor repairs to home and some dollars that were needed to bring the loan current. Fortunately, that wasn't a lot in this case, but we were able to do it. But in this case, our loan was almost $10,000 over current asking prices for new houses. So the only way you can make that deal work is you had to have a back-end creative finance scenario. We looked at the rental marketplace, and you'd be $800, $700 a month upside down if you could rent the house out. If you could do a seller finance transaction, get a reasonable down payment, you can make this deal work. Now, am I going to get a huge down payment in this case? Nope, not going to happen. Too much going on in the market. Price of the house a little bit too high. The dynamics just didn't work. But could I do it? Because when you sell a home with terms, it opens you up to a lot bigger marketplace to make things happen. I always like to try to make about $1,000 a month on my creative finance deals. In this case, not going to happen. I had to cut it in half. Could I get a 9.5% interest rate? Nope. Had to cut that down to, I think, 7 or 7.5%. But did it work? Absolutely. But it was looking at that deal and analyzing it differently and looking at my various strategies where in a retail sale, not even an option. A rental type arrangement, not even an option. That leaves me with one scenario. Could I do it? Yep, and it worked. So as you go into a transaction, you've got to look at all these dynamics. You've got to have a good feel for the neighborhood you're in. What is that demographic makeup? Who lives there? And there's all sorts of ways online to find those items, and you get a good feel for it. You can talk to other investors, maybe there are realtors, they can give you some ideas about what's going on there. When you pull your comps, you can look at days on the market. If you're seeing short days on the market, maybe that tells you got a good moving neighborhood that has a good retail option available if the house lends it to that. In other situations, if you're finding very few sales in an area or high days on the market, maybe it's telling you you're seeing a lot of owner financing or a lot of investor retail sales in that neighborhood. It could also tell you there's not a lot of turnover possibly as one of the things. So you got to get a feel for these issues and learn how to look at that. There's a time and place for everything you're doing. Again, the marketplace gives you a lot of direction as well. We go back to maybe 2019, 20, 21, 22. Here in the Texas marketplace at least, house sales were flying off the shelf left and right. So maybe you had an opportunity for a quick fix and flip, even selling a house over market value that would allow you to pay a little bit more money for the house, whether it's buying it subject to with some equity to the seller or cash or a second lien, whatever it might be, where you could still market that home and make that profit. There was a company here in Dallas that was actually their strategy. They would go in, they would buy the property, knowing that by the time they bought it, got it renovated, that they knew the property was going to go up in value so much, they were willing to make that smaller profit in order to do more deals. They were going to make their money in volume, not making their money on a singular type transaction out there. So again, so many things and dynamics affect how we maximize our strategies. The current marketplace you're in, we're getting back to a normality of the marketplace where the average home is taking anywhere from 4 to 6 months to sell in the market out there. Doesn't matter where you are, it just doesn't fly off the shelf in a day or two. So you've got to be able to build that into the transaction. Knowing the marketplace where your home is located makes a big effect as well. Am I in a retail area? Am I in a rental marketplace? Am I in a depressed area? What's going on? Is this an area that's being regentrified? Am I close to the CBD, the central business district, downtown someplace? In fact, I was at a neighborhood just a weekend or two ago where for the entirety of my career, this has been a neighborhood that I didn't even want to go drive in because I'd be scared to death I'd get shot. And I'm not kidding at all here. It was a rough neighborhood part of Dallas. I went there today and oh my gosh, houses scraped, new apartments up, renovations everywhere, new construction going on left and right. Blew me away. You're going, you've got to be kidding me. That is regentrification, and it happens in every city wherever you are. And so even though I'm sitting there going, no, 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 I took the time, went out, drove it, I'm going, oh my gosh, yes, yes, yes. Things change. And you're watching this stuff, and these houses, when we pulled up multiple listing, very few sales. Why? They were selling off market from the builders without even having to list the house for sale. And in this case, very close to downtown. And so it was a new marketplace, and you could tell it was happening because otherwise the builders aren't going to go in there and start building either. So you look at those dynamics of your area and what you are, and you also look at your rental rates. What are rents in an area? What is the mortgage payment if I'm buying it subject to, or if I'm getting a bank loan, what's going to be my PITI? and how much money am I out of pocket, and will rent work or not? And if it does or doesn't, great. Then you look at your other strategy, which is seller financing. You've got to analyze each one of these deals and you determine the best mechanism of what it is. Now, you don't wait, as I said earlier, to make the decision after you buy the house. You have to do it before you buy the house. Put your strategy together. So many investors, their thought process stops right here at the end of their nose. They're just happy to get the property. They don't know how to analyze that subject to deal properly. They want to pay realtors these big fees. They want to pay the seller all this money just because they're willing to do a subject to deal. And they think that somehow this can be possible. But guys, if it takes 6, 8, 10 years to recoup the money you're out of pocket, that may not be a deal for a lot of investors. There might be an investor out there who wants to do it. I get it. Different strokes for different folks in every scenario. But realistically, no. I can tell you in those kind of scenarios, the average investor wants to get their money recouped in 24, 36 months typically. And when you start pushing the envelope, it's just not a good deal. Learning how to analyze these deals is so important. Knowing your marketplace, knowing your demographic in the neighborhood, knowing what's going on in the environment, what's the mortgage marketplace doing. All of this affects your deal to help you maximize your profit. So take the time, become a student of these items, put it all together, do your homework up front as you're looking at these deals, and you'll find it'll help you maximize your profits along the way. So guys, I hope you found this helpful. If you did, take a minute and like the video for us. Don't forget to comment below. We'll do our best to comment and get back to you on those. And don't forget to subscribe to our YouTube channel again. We'll see you all next time.